So learning about other people and who you could work with and who you want to work with and formating some kind of team is extremely important, very important in this business. So there's different options on how to get in and be an active investor. And that's actually doing the operations.
Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder and CEO of Zana Investments, Tim Little. And on today's show, we have with us Jeff Greenberg. Jeff is the president and CEO of Synergetic Investment Group. Through SIG Wealth Fund, Jeff provides the opportunity for high net worth individuals to passively invest in commercial real estate with best-in-class commercial deal syndicators. Jeff uses his extensive experience and network to help investors to discover and invest in high-quality alternative investments. Jeff has been involved in projects worth nearly $150 million, consisting of over 2,000 units, and has been involved with all types of assets from student housing to short-term rentals and market-rate multifamily properties. Jeff, welcome to the show.
Thank you very much for having me. I'm looking forward to this.
Yeah, and it's great to have you. So I gave everyone a high-level overview of your background, but on this show, we really like to get into the details of how you got started on your journey to multifamily millions. So please take us back to the beginning and let us know where you are today and how you got started.
Yeah, back in the beginning was actually around 2005, where I was actually looking at single family POs, bank-owned properties. And at that time, the banks didn't really know what to do with all of the foreclosures that were coming onto their books. And it was difficult because prices were still dropping down, at least in the area that I was looking. And so it just wasn't working on the single family scene. And I happened to go to a real estate event where I bumped into someone that was talking about multifamily. I went to his event and I started learning that I could leverage the limited amount of money that I had and actually get into commercial real estate, which totally was out of my train of thought at that time or prior to that, because I was actually going through a divorce. And so I had limited funds, but to find out that I could leverage my funds and use other people's funds to get into real estate and to get farther in. And so I went from there. Went through some programs and had some mentoring. And the first property I bought, other than my own single family residence, was a 20-unit property in Texas. And so that was the first, and we syndicated that. We raised money for that. And that was the first real estate I had done other than my own.
Wow. Okay. So yeah, you talked about the single family REOs. I've always thought about that as a great opportunity, but never jumped on it. And I'm glad I didn't, because I was looking at it around the 2005, 2006 timeframe. Getting into a single family houses back then probably wouldn't have been my best business move. But then, like you, I think the curtain was opened to me about commercial real estate syndications. I think, like most people, I just didn't know it was a thing. And I didn't know there was this way your money into these. I just assumed rich people owned apartment buildings, and that was it. I didn't think it was real people. I thought it was huge corporations or banks or whoever. So it sounds like you had a similar epiphany when it comes to commercial real estate.
Yeah, you're going to ask somebody, so who owns that? Oh, a syndicate. Well, what the hell is a syndicate? Is it the mafia owns it or something? The only thing I'd ever heard about syndication was like radio shows or something, or TV shows that were syndicated. That's the only time I had ever heard that term being used. So you didn't realize that it was just a bunch of people being brought together to make a large purchase. And it doesn't even have to be real estate. You could syndicate the purchase of a boat or a car or whatever. You could bring people together to make a large purchase that you couldn't do on your own. And I had no clue about any of that.
Yeah. And I think one thing that gets confusing for people that are new to this industry, they hear that and they say, okay, I get it. Syndication is the pooling of resources to take down an asset like that. And I think a question that might come up is then what's the difference between that and a joint venture? Joint venture is a couple of people coming together with money to take down an asset. So can you help clear up what the difference between those two deal types are?
Yeah, the joint venture, basically everybody's coming in. They probably are coming in with equal amounts of money. They may or may not be, but they all have responsibilities. They all have jobs to do within the project, whatever it happens to be. Where a syndication, you have your GP, which is your general partners, and your limited partners. The limited partners come in, and their job basically is to bring the money in and obviously to do their due diligence up front to decide if they want to be in the deal, but they're not running the deal. And typically they have very little say so and have very little options once they're in the deal. It's being run by the general partner. And that's why the general partner is so critical as far as the components of a syndication. And so anytime somebody brings in an investment of money and doesn't have control over that money, they're relying on somebody else, it becomes a security as far as the SEC is concerned. And basically, a syndication is a fancy way of talking about basically a security. And so that's what it is. The investors don't have control of their money. Somebody else, they're relying on somebody else for the success of the venture.
No, and that was a great breakdown. And you're right. I think especially that piece about what you said about joint venture is different in that you like legally need to be involved in some way. Whereas the benefit for someone who wants to be a passive investor is that with the syndication, they can once they hand over their money, there isn't really responsibilities thrust upon them. They can be as involved with asking questions and stuff like that, but they don't have any legal rights to make decisions, I guess is the best way to put it.
Yeah, most of the time, and that's something important to read in the operating agreement and the PPM to see what their rights are. And typically, they don't have much in the way of rights to do much of anything. Sometimes there may be a vote on if you want to sell. There may be some voting rights that if the group decides they want to get rid of the manager or something of that sort, where there's something going on, that they may be able to vote, make that kind of vote. But it's pretty much limited as far as rights they have. But now typically they do have rights to see the books. And I've had friends of mine come up and having in a problem syndication and saying, "Hey, they said I can't see the books for 6 months." And I'm saying, "Well, wait, go back to your operating agreement. What does it say?" And typically they say you have the rights to see the accounting and you should be able to demand that you see that. So your responsibility is to keep an eye on things. But as you said, it's not a legal responsibility, but it's your investment and you have the right to keep an eye on what's going on. Look at the books when the financials, when they come out, and just make sure that you think that everything is going.
Yeah, and I think that's an important point that you bring up for the passive investors is that PPM, which is the private placement memorandum. It's a scary document for a lot of people. One, because it's long, but two, because it really talks about all the potential pitfalls of that deal. But that's the again the legal requirement in terms of disclosures to say, hey, this is all the bad things that can go wrong. But it also tells the rights of that investor. So it's important from that respect. So even though it may be a scary document and it's really long, they should dig into it a little bit so that they understand what their rights are within that deal.
And in parts of the PPM, people call the PPM, the whole package. But as you said, part of the PPM is the disclosures, but then the legal piece is the operating agreement. And that's a legal document that you'll sign that tells you the operation, how the entity is going to be operated. And that's important. That's very important as well.
Yep, absolutely. So you talked about the programs and mentoring that you did before you really dove into this. How important do you think that education piece was to really being successful and to giving you the confidence that you needed to even get in on that first 20 unit?
I think everybody needs some kind of coach. It just depends on how you're going about it. Some people will go to formal programs, pay a lot of money, And as long as they work at it and they really go and follow through, they probably will do well. Biggest problem I see with a lot of those formal programs, and I've been a coach on and for some of these gurus in the past that I've done coaching, but the things it still takes you as the active investor to go ahead and follow through on all of that. I do believe also there's other ways of doing it. I usually tell people to find somebody that's doing what they want to do and to find a way to be of some benefit to them, to help them in some way, not worrying about getting paid or what, just, hey, being boots on the ground, or maybe you're willing to fly out and walk a property, or whatever you can do to help out somebody that's doing it. That's another way of getting an education, more of an apprentice type of education. Nothing wrong with that. And then there's the other ones that start out with a single family home and then move it up to a duplex and a quad. And then I think that is probably the slowest process. It's doable and there's people doing it, but that takes, I think, a lot more time. Learning from other people, either through a paid mentorship or of some kind of like an apprenticeship where you're able to be around somebody that's been doing it and learn from them, is probably the best way to do it. And this business team is very important. So learning about other people and who you can work with and who you want to work with and formating some kind of team is extremely important. Very important in this business. So there's different options on how to get in and be an active investor. And that's actually doing the operations.
Yeah. And I guess for myself, I did all of the above, right? I started off with a duplex, traded up to a triplex, and or somewhere in that time is when I discovered multifamily and the benefits of scale and all that. And so I was like, oh, okay. And so then what did I do? I started to surround myself with people like you, going to conferences and stuff like that, and then trying, just like you said, to figure out where I can add value. And I think a key part of that for anyone who is trying to do that is to not be, like you said, see where you can add value first. And don't, if you can get in on a deal as a general partner, don't be greedy and be happy with the slice of the pie that you get. Don't obviously let yourself get screwed over. But at the same time, it's not about the slice of the pie, because the education that you get by even getting into that deal and seeing it through is far more valuable than that extra 1%, whatever it is that you're trying to negotiate for on that deal. And more than likely, that getting in on that one deal as a general partner will give you the track record that you need to get started and potentially or likely get onto other deals in the future. So that's my best advice for anyone looking to break in.
Yeah, and even getting in as a passive investor is good way. I know a lot of people that started out as a passive investor, then they worked their way into the general partnership, and then from there they worked their way up to be the main general partner and doing their own deals, learning on the way. The first deal I invested in was a 700 unit portfolio of properties. The only problem is I learned what not to do. I learned how not to treat investors. I didn't feel that I was being treated properly, but that was an education that was very important. So when with my investors, I make sure that I treat them better than I was being treated in that.
Yeah, and sometimes those lessons are far more important than what how to do them. And if you learn what not to do, that could be a super powerful lesson. And you're absolutely right on the passive investor piece. You beat me to that one. I did the same thing before I ever got in as a GP. I was a passive investor. One, because I wasn't ready to lay down the money for the guru piece. And I was like, what if I can earn money while I'm learning? And that's why I call that earn while you learn, because I was able to ask all the questions that I had of that operator, who luckily was successful and, and treated me well in this instance. But at the same time, I was earning money, right? So that's definitely a plus too. And like you said, I was able to better identify with the passive investors and understand from their perspective. So I think
Yeah,
that's important too.
yeah, that's an important point that you brought up. as far as being able to ask the questions. And I tell people all the time, when you come in as a passive investor, you're now an investor. You have a right to ask a lot of questions. Now, I'm not telling you to be a pain in the ass, but the thing is to think about what's going on and ask questions. It's your money. You have the
Mhm.
right to do it, but also to learn, that you're anxious to learn. Now, not every deal sponsor is going to be open to that type of mentoring or answering lots of questions. So you've got to make sure that you're in a deal with the right sponsor, someone that understands that you want to learn about the business and that you're going to ask questions. But think about the questions, but ask good quality questions and find out what's going on. Learn about the business. Everybody
Yeah,
started somewhere. Everybody was a beginner at some point, and that's important. And you've got a ticket to the door when you're investing.
absolutely. All right. So I mentioned at the top of the show that you run a diversified, customizable private equity fund. First, can you explain what that is and what it looks like in practice for the passive investor?
Yeah, for years I've wanted to create a fund to fund my deals, the deals that I was syndicating, because I syndicated for over 12 years. And my deal flow, I didn't feel was sufficient to really create a fund. I didn't want to feel any pressure about getting into deals just because I had people's money that was ready to go. I didn't want to feel that kind of pressure. So I didn't do a fund until more recently. I've been doing a fund for a little over a year now. And basically, we go into other people's deals as LPs. But what's unique about the fund that I have, and there's some other people that are doing similar things, is it's diversified. Let me start with the customizable. It's customizable, which means that you are not required to be in every opportunity within the fund. The investors could pick and which opportunities. So it may be student housing, multifamily, self storage, mobile home parks, anything within the alternative investment criteria, which is a lot of other things. And you would get to pick and choose. Now, because you get to pick and choose, I could make it a diversified fund and have all different kinds of opportunities, as I mentioned in there, without turning off people. Some people might say, I don't like mobile home parks, or I don't like self storage, or I don't like short term rentals, or whatever it happens to be. Okay. So they don't have to be in that opportunity. The other thing I get to do is look for opportunities maybe that has high cash flow, but maybe it doesn't have capital appreciation as much. Or maybe I can do one that has high capital appreciation, but maybe there's very little cash flow, maybe like development, where you're not going to get any cash flow up front, but you're going to get your capital appreciation in the back. And the investors can pick and choose which ones they want to be in. So basically, they're self diversifying by picking and choosing the opportunities that are brought into the fund. And through the fund, we at the end of the year, we're going to be getting our a single K1 for no matter how many opportunities you're in within the fund, but you get one K1 from the fund. Now, we talked earlier about the PPM. The only PPM that the investors have to read, put it this way, they have the opportunity to read, is the fund PPM, and they need to sign that. Now, when we get into an opportunity, we provide the PPM and operating agreement for the deal that we're going into, but the investors don't have to sign that. I sign that on behalf of the fund. So they can read it to get all the disclosures so they totally understand the opportunity. And then they have the last choice of whether or not they want to be in it. So basically, they've got me looking out for them and finding the deals and the deal sponsors, and they get the last choice as far as whether or not they want to be in that opportunity. So that's makes it very unique as far as the different types of funds. Most funds, you're in whatever deals the fund manager brings in, that you're required to be in all of those deals. And you're diversified as far as they make it diversified. It could be across sponsors, or there's people that have funds that are just for their own deals. And so there's less diversification. You're just across their multiple deals and not multiple sponsors. Could be multiple regions.
Yeah. Okay. That was an excellent breakdown. And I appreciate that. You even answered some of the questions that I was going to ask you as you were talking, specifically when it comes to the tax treatment and ensuring that passive investors get the same benefits. But you said it comes down to them as a single K1, regardless of how many assets are in their investment.
Exactly. Yeah. 1K1. And so they have to just deal with that one. And we get the K1s. The K1s come into the fund, and then we create the K1s for each investor.
Okay, no, that's great. And so I definitely see the advantage there from the passive investor perspective, especially when you talk about it being customizable. Because what's so important for us as sponsors on the regular syndication side is making sure not only that we get the right deals for investors, but that the investors are going into the right deals for their investing goals, i.e.,
Mm.
if they're looking for cash flow, I don't want to pitch them something that's an appreciation play and vice versa. And we have to be very transparent about that upfront. Cause like you said, some deals you may not see cash flow for the first year if it's a heavy value add, or maybe longer if it's a complete ground up development. And if that's what that investor is banking on for their retirement or whatever, that's not going to work for them. And so what you're saying is they can see the different assets available and choose what best fits their investing goals.
Exactly. I know some people that are investing in ATM funds. ATM funds are cash flow. That's it. You get your equity back and you get cash flow. But at the end of the deal, the machines are worthless. So there's no capital appreciation. Now there's a high cash flow and you're going to get your initial investment back, and then the rest is all profit. So it's a great opportunity to get into. But at the end of the day, when the fund closes, there's nothing. You're not selling off the machines that they're worth anything.
Yeah, no big payoff at the end. It's
No,
all
which is the
collateral.
opposite of multifamily. Multifamily, most of your payoff is at the end.
Right. You do all these different types of assets. And I guess I'm curious, do you become an expert at multiple different asset types, or are you really relying on the expertise of the sponsors and your value comes in evaluating those sponsors and whether they have a good track record, et cetera?
I'm an expert on no. No, I definitely am relying on the expertise of those people and fairly slow about adopting new sponsors and new assets. I need to really get into the dirt and learn about the investment we're going into, especially if I'm bringing investors in with me. I may be more quick to jump in if it's just my money, but when it's investors' money, I'm definitely digging deeper and making sure that it's going to be safe for all of us. But yeah, I definitely rely on sponsors, which are number one in my book as far as what I'm looking for is good deal sponsors, and not even worrying about if they have a current deal. I want to know them. And then when they get current deals, then I've already got that piece taken care of.
Yeah, and I've heard some fund operators talk about their requirements, and some of them are pretty stringent, 20 deals having gone full cycle and things like that. Do you have any set criteria? Yeah, I don't know. Talk to me a little bit about what that process looks like for you.
I don't have any set criteria, nothing cut and dried. I want to get to know them. I want to get to know their operation. I want to know their business model, and typically I'll go to visit them at their office, or I want to meet them in person at least. I may go to some of their properties and look at some of their operation, but I do want to get to know them before I get into it.
Okay. No, that makes sense. Yeah, you definitely get a better feel for a person when you can shake their hand and sit down and have coffee with them or something like that.
Yeah, and I also want to talk to want to talk to some of their investors, which of course they're only going to refer their best investors to me. But still, you could get an idea of their communication and their ability to run the operation.
Yeah. And with so many different asset types in your portfolio right now, what are you liking the most? I guess I would say with things being changing so quickly right now in terms of rates and stuff like that, is there any one asset that probably is looking better for the next 1 to 3 years than others, or is it balanced?
First, to be clear, those we were talking about a lot of asset types that I want to be in that I'm interested in. I don't have all of those in there. Right now, I have one I've got a short-term rental, I've got multifamily, I've got one new development, a few of those. But as far as what I'm looking for in the future, right now I'm doing a little bit of looking into RV parks. It's a asset type that, let me back up. Multifamily was the sweetheart, and it still is the basis. And then people started saying, I could still go get 10 caps on mobile home parks. And then we know that's gotten tight. And they said, okay, we could get 10 caps in self storage. That's not there anymore. And now you've got RV parks, RV and campgrounds that are still looking at those kind of high caps. So it's a little bit of up and coming. So I am looking at that. It might be a good time to be getting into that. Multifamily, I think, is going to be looking good in the next year, 6 months to a year, as long as a lot of distressed assets are going to be coming around. And when I say distressed assets, it's typically, the way I see it, is distressed debt. That there are a lot of people that are in debt, or in their finances are going to have a difficult time because they didn't plan for these kind of interest rate increases. And there's a lot of people that may have to either refinance or move their property because not able to make the payments. Either the interest rate has gone up because they didn't buy a rate cap, or they bought a rate cap and now that future rate cap that they're going to have to buy is way too. And I know people in both of those situations, as well as people that are doing capital calls to keep their finances going. So there are going to be deals in distress. And so down the road, I'll be looking more at multifamily, but very cautiously with good debt. And the
Yeah.
deal that we just closed on I was very happy when I found out that it was a fixed debt for, I think we got 10 years fixed rate debt, and the leverage was about 65%. So that makes it a lot more of a safe deal in my consideration.
Yeah, I think that long-term debt is going to be key right now. That and maybe like seller financing where you can find it. That's something we're looking at on a joint venture deal right now. I won't call it, it's kind of mom and pop, like 22, 24 unit. So you can make deals like that happen more creatively, but you're absolutely right. I know there has to be a lot of sponsors that are in a situation right now where their business plan called for refinance in year 3. And right now is year 3 and it's not looking so great for refinance. And then in terms of those caps, yeah, rate cap that may have cost 100,000 3 years ago, or even 2 years ago, it is costing like 800,000 now. And that can
Millions. I know people
it-
paying over million on rate caps. I paid 20,000 on a rate cap about 3 years ago.
yeah, that alone could just destroy a deal unless it's just amazing. So
Absolutely. And I know someone that's had a 3-year rate cap, and they were escrowing for year 4 and 5. And the escrow was $9,000 a month. And they've just been told that escrow has gone up to $55,000 a month. There's not a lot of deals that can withstand that. Either you're not going to have any distributions, or you're not going to be able to pay your bills. So that's a pretty rough.
yeah, neither is a good place to be.
No.
All right. Hey, this has been some great conversation, Jeff, but I do have to move on to the turbo round. So I'm going to ask you 3 questions that I ask every guest that I have on the show. And I just ask that you give me an honest answer in as quickly as possible. So the first question that I have is, what is one red flag every investor should look out for? And that could be either a passive or active investor.
Anytime you're getting into a deal, I feel the main thing is you need to see that the alignment between the general partners and the limited partners is in alignment, that everybody's needs are lined up, and that the GP is going to be incentivized to make a very successful deal. So they're not taking a huge acquisition fee and then not worrying about the profit at the end. You want to be in alignment. That's why a lot of investors like the preferred returns, where the deal sponsor doesn't get anything until the pref comes in. And then afterwards, you can have the splits, but looking at also what the splits are. But you want an alignment of thought.
Yeah, exactly. And of course, it's a balance, right? The operators certainly need to get paid for all the work and the money that they're putting into that deal, but it has to be balanced with what the investors are owed based on the fact that they're bringing most of the money to the deal. So you're right. I think investors need to look at all aspects of that, not just the pref, but I think that's the most obvious one that I think people default to. But there's splits and other things that they need to compare in order to get a feel of whether their interests are top of mind for that operator. All right. Question number 2. What is a myth about this business that you would like to set?
There's some people think it's a get rich quick business, and it isn't. It's a lot of people get rich in this business, but you work at it. It's not a complicated business, but it's not easy. There is a lot of work. There's a lot of dedication. And those people that tell you that you can quit your job in 6 months or something are probably feeding you a line and are probably going to want you to join their mentoring program for $30,000, $40,000. Certainly you can make a lot of money. It takes time. It takes time, effort, a lot of energy.
But yeah, I can't emphasize that enough. This isn't do one deal and you found financial freedom. I don't care what someone tells you.
That's
All
right.
right. So the final question, what does success look like to you? And this can be personal, business. It's really wherever you want to take it.
Time freedom. Being able to do things without worrying about where your money's coming from. Being able to spend time with the kids and the grandkids and take the dogs for a walk in the middle of the day, or take a 2-hour bike ride, which I do every other day. That's what it is to me, is being able to spend my time the way that I want it. And of course, the finances is what makes that happen, is being able to do that and spend that time.
Exactly. We hear that from so many people. It's not about the money for money's sake. It's about the money to create that freedom of time that we're really looking for.
Absolutely. And it could be time with your family. It could be time traveling. It could be doing all kinds of things. But time is something that we just don't get any more of. You and I talked earlier about young kids. The time that you spent with your kids is so important. Nobody's going to say at your gravesite, he worked hard and made a lot of money. It's how much time you spend with your family and your friends, and that's more important than anything else. It's the money that helps you get there.
Absolutely. Hey, Jeff, this has been great conversation. Please tell our guests how they can get a hold of you, and if you have anything else that you would like to share.
Sure, absolutely. You can get a hold. My website is synergetic.ig.com. And you could get a hold of me at jeff@synergetic.ig.com. And you can see the spelling for Synergetic right behind me. And I have a gift for your listeners. If you go to sigcre.com/sponsor, it's questions to ask before you ever get into a deal, if you're looking to get into a deal as a passive investor. But it's also if you want to be a active investor. It's questions that you should be thinking about, that your investors are going to be thinking about if they're going to invest with you, even if you're going to be on the active.
Hey, Jeff, I really appreciate you giving that to our listeners, and definitely appreciate you coming on the show. I know you brought a lot of value here explaining funds and syndications in general, which can just have an air of mystery about them, especially for people who are not familiar. So thank you again for your expertise and for coming on. And we all look forward to seeing you continue to do big things on your journey to multifamily millions.
Thank you so much for having me. This was a lot of fun.
All right. Thanks, Jeff. Have a good one.
You too.